What's going on, everybody, and welcome to the November 2019 Investors Digest Market Update or Investors Journey podcast, depending on how you're tuning into this, or the YouTube or podcasts, or however you might have stumbled across this, Facebook or Instagram, kind of all over the place. So if you guys if you're turning into this on YouTube or something like that, I highly suggest you go over and wherever you get your podcasts and search Investor's Journey. We put out a weekly podcast. This is one of the episodes, but my business partner, John, puts out a lot of tips and tricks about what we're doing in our business today and what lessons we've learned to kind of along our journey to become better investors, and we want to share that with everybody. So a lot of good feedback we've gotten from it, so I highly encourage you to go over and check that out. So to go ahead and get started with it, the numbers overview for October and November. October sales prices, average sales price rose 8.15%, big jump to 277,680. Median sales price was a 5.5% increase year over year to $221,600. Total sales saw a massive jump to 11.2% increase year over year to 2860. That's a big jump in the total sales, especially for this time of year. Typically, this time of year, we have a little bit of a slowdown as far as sales volume for the fact that we're heading into the winter months and not as many people are out looking for homes and trying to move around. And that's just typically our cycles that we kind of run through, and you'll see it on the next slide. The average rental price was $1,453, just a slight 0.5% increase year over year, but we did see a big year over year jump last month, so no surprise to see this kind of tick down a little bit. Employment here in the San Antonio area is just shy of 1.2 million. So we gained just 13,000 jobs from the previous month. So if we gain something like that again, we will break the 1.2 million employment here in San Antonio. And you see how it's a 3.23% increase year over year, which is out of the norm. We're usually about one, maybe low twos, never really hit the threes that often as far as employment growth. So that's really good to see that many people are moving to San Antonio, especially really good for a real estate market. Because if you got a dying population or people are moving out, a net migration loss, that's not good for real estate prices, because that puts a downward pressure on the real estate prices, because that means people aren't wanting to pay. There's more inventory being created than people consuming. So when we have an increase, that's good news that we have a lot of people moving here, so there's demand for new housing, which if they can't keep up, which they haven't been lately, there's going to be high demand for single-family houses. So that puts an increase on the prices of the housing stock that is here. Another something goes hand in hand with employment is the unemployment rate. And we are sitting at 2.91, which is a 0.05% decrease from the previous month. So we're below the Texas average, below the national average, and we're growing employment at a very rapid rate. So those are all good things for the real estate market here in San Antonio. Our month's inventory is 3.91, which is a 0.11 decrease from the previous month. Now, for those of you that might be tuning into this for the first time or need a quick refresher of what the month's inventory is, that basically says if the same number of people bought houses last month buy houses this month and no new houses got listed, how long would it take for all of the real estate to be consumed and nothing be for sale on the open market? And that's measured in months at 3.91 months. So if we sold 2,800 homes again this month, it would take roughly less than 4 months for every house to be sold on the MLS. So now how do you use that? That basically says the equilibrium for your economics refresher is the supply and demand equilibrium is at 6 months of inventory, where they say, no, it's not really a buyer's market, not really a seller's market, it's a balanced market. Anytime we're below 6 months, we're more into a seller's market. That means there's a lot of people trying to buy houses and not enough inventory, so the seller has a little bit more of a advantage than the buyer, because people know houses are selling quickly, they're not staying in the market that long, they can afford to wait a little bit, or say, I don't want to give you those concessions, I'll wait for the next buyer to come along. So that's really how that means. So the lower that number gets, the more of a seller demand there is, or advantage there is, and more of a demand for buyer, and that tends to push up real estate prices over the long haul, and you'll see why here in a few slides as I break it down into zip codes and by price range. So now the median sales prices, this is where I was talking about that we have our real estate cycles. You can kind of see where we bottomed out coming out of that last recession, and then we kind of go up in the summer, down winter, up summer, down winter, and that has continued for quite some time. And that's why I continue to watch it, because I want to see year over year, are we continuing to appreciate, are we topping out, or what's going on in the local market. And so that's a lot of things is why when everyone's slowing down sales prices, that's when us and our business, we go into buying mode. I'm trying to buy houses now, trying to find houses that I can buy in the December, January, February, March timeframe, because when I usually take my 2, 3, 4, 5 months, that puts me on the market right about this perfect time that I can catch that next selling season when sales volumes increase by 1,000 households a month and prices continue to rise a little bit higher. Same thing happens with the rents. Up in the summer, down winter. Up summer, down winter. Now, we use this because I structure every one of our leases to end on April 31st, no matter when I start the lease. Because right now I'm renovating two new rental properties that we just picked up, and I'm going to put them on the market, and it's going to probably be around that February, March, April timeframe by the time these things are done, ready to be rent. But I'm going to rent it to end April 31st of 2021. So it'll end up being a 13, 14, or 15-month lease because that gives me time. If that person moves, that puts me on the market right here. So if I need to do some rehab, I get it on the market and I get the next premium rent. And I can let that ride for until they decide to move out. And that allows me to capture that next rent when that person does turn over and move out. Unemployment. I really tend to track this because you can see that how fast coming out of recession, you can see the dot-com bubble and the last subprime mortgage bubble, how fast this unemployment went from 3.6 all the way up to 7.46. And that didn't take very long. I mean, less than a year, employment shot up. But this started about 2008. But real estate prices didn't bottom out till 2011. So using the unemployment rate is a good precursor of what's going on in the market. And you can see we're hitting these historical lows, getting way down here at almost 2.5%. So if I see a 0.5% increase, I'm not really worried about it. If we're hitting 3, 3.25, I'm not really too concerned. But if I saw it go 2.5, 3, 3.75, 4.25, 5, and started rising at a very rapid rate, I would start to really be concerned and start prodding into the data, trying to figure out, hey, what's going on? Why is the unemployment driving up so much? Is it returning to a new norm? Or is something going on that's going to start spilling over into the real estate market? And I really need to see about shifting my strategy and really being conservative on stuff that I'm buying in case I need to offload it if there's less buyers in the market. Because if people aren't employed, they're not buying houses. That means they can't qualify. Eventually, the fearmongers on CNBC and CNN are going to catch on, and they're going to say real estate's crashing, and nobody's going to want to buy houses. So that's why I really track this stuff pretty religiously, and you guys should too, and stay tuned in every month so you can catch the latest data. The year-over-year appreciation. Now, this is something that I started tracking probably about a year ago now because I wanted to know. People were saying that, oh, the real estate's slowing down, it's crashing, it's crashing. Like, is it, or is it just slowing down, returning to more of a norm? And that is my theory on what's really happening. Because you can see how we were down that 2, 6, 7%, and how fast we shot back up, and we were coming out of that last recession, we hit several 10s, up into 11 a little bit too. But the trend has really kind of been at starting to come at like a downward slope. And so that's meaning we're not crashing, but we're not appreciating as fast. And what I think is really causing that is affordability. As prices continue to rise, it's trying to get to that 6 months of inventory, supply and demand equilibrium. So that's why, and so less and less and less buyers are going to be able to afford houses. So that's going to create less and less pressure for appreciation until it finds that equilibrium. So that is another reason why I track this stuff is I want to know, hey, is this starting to go negative? And you can see we haven't had a negative month in almost 7 years now. We've gotten close down here with like 1%, 2.4%, but it kind of recovered and went back up. So this is why I do track this data because I want to see what is a long-term trend. And you can kind of see the total average, it was 5.1. And our monthly average is down to 4.5. So it's not saying we're crashing, but we're not appreciating as fast anymore. So now the question becomes, where to market. What do you do with this data that I just kind of told you about? So where is the most in-demand inventory? Where is that house that you can pick up and in 3-4 years it's worth 20, 30 grand more than what you picked up? Well, let me tell you, break it down by a couple different ways. I do it first by price range. So remember that 2,800 sales? This is where they're all sold at, down by price range. So you can really see the most in-demand housing is in this sub 250 market and under, and really under that 200 market especially. And look where the most of the volume is sold. I mean, you're looking at almost a third of the volume sold between 100 and 250,000. That's why for us in our business, we love staying under that 250,000 price point as much as possible. We really don't mess with much into the 300s, 400s, definitely not into the 500s, because look at your monthly inventory. Look at the sales volume. Not many sales, and you have that 6 months inventory. Remember, it's at that equilibrium, so no buyer or seller really has negotiating over each other, and they kind of take a long time to sell. And especially you get over these $1 million properties, there's 15 months of inventory, over a year worth of inventory on the market. So there's kind of pressures for prices to potentially drop a little bit, possibly. That's not every time, but there is a kind of a rule of thumb there of a low gauge. That's why we stay for our business. We stay in that sub 250 as much as possible, because that is where the majority of the sales volume happens and the lowest months of inventory really are. They're more in our favor, being the sellers, if we're buying a property to sell. And now that's also something for us that we want to buy and hold in that price range as well, because the low months inventory, that's going to continue to push prices up, making our real estate worth more and more value, more equity, because that's a very in-demand price point. And honestly, builders really can't build at scale and volume sub 200, definitely under 150, and it gets a little harder the more that price goes up. So that's why there's a big demand in there. That's your entry-level price point now, because builders physically can't build massive subdivisions for $150,000. If they are, they're way out in the county, and I've seen some here in San Antonio on the far east side, and they are tiny little 1,000 square foot square houses, no porch, no garage, no backyard, very minimal lot line. So it's a house with a roof, but it's $140,000, and that's really all you get. But there are not that many of them being sold in that little subdivision. So let's get to the next section. Now, lowest months of inventory by zip code. Where in San Antonio do you find the most in-demand housing? So right now it's 78239, which is kind of over off of the northeast side over, I think that's Windcrest, I'm not sure, 78202 and 207. Now, I put next to this to really kind of put a picture out here to where or what this low months inventory really do to this price point. So you can see in November 2017, the average sales price is $150,000, and now we're just shy of $180,000 2 years later in this zip code. So that's what this low months of inventory, when I was saying earlier, puts pressure for prices to rise. This is what happens. Same thing here, 142 to 186. Now, 78207 was not zero 2 years ago and rose to 92,000. That's not some kind of secret voodoo going on down there. That means literally 2 years ago, no houses were selling in that 78207 zip code, and that is directly west of downtown. It's a very large zip code, but those houses are very old, need heavy rehabs, so it's taken some time for that inventory stock, for the prices to rise enough to make sense to go in there, put the capital improvements into them to get those properties sold. So if you want a complete list of this, of all the zip codes here in the San Antonio MSA, shoot me an email. My contact is on the very last page, and I can send you the spreadsheet with all of the zip codes on them. Now, here's the highest months of inventory here in San Antonio. Now, it's not to say these are overly bad zip codes by any means, but it just says there's more inventory out there, and it's no surprise to see a lot of these are in that, well, actually, surprisingly not that many this month. Typically, they are very high-priced zip codes in like $200,000, $300,000, $400,000, $500,000, but some of them are. So that's why when you see these months of inventory, you really need to take into account what do you need to do to your property to make sure you're not sitting on the market that long. You're not on here for 5-6 months, as some of these zip codes kind of tend to be. You might need to put more into the countertops, more to the kitchen by putting nicer countertops. There we go. Landscaping, staging, pictures. Really make sure that your house If you have a lot of inventory in a market, isn't sitting in the market for that long. So a lot of these zip codes are kind of older downtown zip codes that are a lot of inventory sitting in the market and they're not getting really sold. You need to make sure that your quality of your rehab really is there, that you can get your house sold, because if you got a $200,000, $300,000, $400,000 hard money loan, every interest payment is straight out of your bottom line. You get no value on that. So you want to make sure that your property turns over very quickly and you can get it sold so you can get out of that project. Like I said, that is it. If you're watching this on YouTube or listening to it on the Investor Journey podcast, I highly suggest you go over to PRYMEHomes.com and subscribe to the Investor's Digest so that you can get a PDF copy in your email box every month. It'll link you to this video, and you can get a PDF copy of all the slides so you can kind of put what I'm talking about to a visual aspect of it so you can understand what exactly is going on. If you have any questions, go ahead and shoot me an email. If you want that full list of all the zip codes here in San Antonio, shoot me an email at john@primehomes.com. If you're listening to this on YouTube, definitely go to wherever you get your podcasts and search Investor's Journey to kind of get tips and tricks of what's going on in our business and things that we're learning along the way. And go ahead and give us a shout out on social media at primehomes.com. Otherwise, I will see you guys next month.